Hello everyone and welcome back for part 4 of the beginner series. If you've made it this far, then congrats to you. You are part of the minority looking for my analytics. So very well done to sticking with it, and we're going to keep moving forward from here. So you should be quite invested by now, and hopefully you are, because it's life-changing stuff that I'm showing you. And again, you should want to be learning this sort of thing. Okay? When you start using it yourself, you'll start to see how it can change your life. Okay, so I just want to really give you some motivation from the beginning. Well done for making it this far. So we've talked about time zones, liquidity. We've talked about the open, high, low, and close, and the mindset that we're trying to target where liquidity is and where retail traders have their orders. So we've covered that so far. We've covered fair value gaps, what relative equal highs are and how they're likely to be traded to. And then we've also talked about inversion fair value gaps, and we've talked about volume imbalances. Okay. So now we're going to talk about some more PG arrays. So let's talk about market structure shifts to start with. So you need to identify swing highs and swing lows. So swing highs are where you've got 3 candles, 1, 2, 3, where the middle candle is bigger than the candle on the left, higher than the candle on the left, and higher than the candle on the right. So that would be a swing high. Same here, where you have the high of this candle is higher than the high of this candle and the high of this candle. So this would be a swing high in here. Okay. Swing lows, on the other hand, are where the low is lower on this candle than the low of this candle and this candle. So take this out of the way a second. You can see that low. Same here. Low, this low is lower than that one and that one. Okay, so you've got to really look at it. Same here. Swing low, swing low, swing high, swing high. Okay, you can see as you spot through price. So if you are in a downwards market and then your swing high gets traded through here, that's called a market structure shift, and that's a PD array in price delivery array. Thing that you look at, that's key. Okay, so you often find a lot of these concepts overlap. So see how you've got an inversion fair value gap, yeah, and you have a market structure shift, yeah, that at a macro time. So see how things are overlapping that I'm looking at to get into trades. Okay, here again, swing low gets traded through. So now that's a market structure shift here to get into a sell at what? A macro time. So adding to this, you can now look at something that's called a breaker. So a breaker is when you've got a bearish breaker is when you've got a high, low, higher high, lower low, yeah, and then it's the last down candle you see. So let's have a look. High, low, higher high, lower low. I'm saying that the lower low is here, isn't it? Okay. This, because that's lower than that one. Okay, you see that? High, low, higher high, lower low. Then the lowest down candle is your breaker. So in here, it has to be prior to this, yeah, to be a breaker. So this would be your breaker. And you don't want to see the bodies trade in the upper half. Remember the wicks can. You don't want to see the bodies trade in the upper half of a bearish breaker. For the bearish breaker, you need the bearish candle. The bullish breaker, you need to look at the bullish candle. Let's see if we can find a bullish breaker. So you've got a high, a low, a high, a lower low, yeah, and then a higher high here. So this candle slightly higher than that candle and that candle. Then you use the last up candle this time. And you've got the entry. Yeah. Within the macro time, so you could buy here, trade higher. Again, stop loss needs to be below the low of the breaker, which we traded above. So there's various ways to get entries. I'll say this again. Make note: low, high, lower low, higher high, last up candle, breaker. Bearish candle, got a high, low, higher high, lower low, last down candle, trade lower. This one is an easier example to see than this one, so use this one for your notes. Okay, so that's your bullish breaker, that's your bearish breaker. What it means is high and low. Liquidity has been swept for people who went short too early, because we're not in what macro time. So everyone's order stop losses got hit, and then we go. Same again. Everyone who's gone long too early, stop losses got hit, and then we go. Okay. Now we'll talk about overlapping bodies, which are often you see quite a lot of the time, which are also used as key areas to run price off. So let me see if I can look back and see them. When I talk about overlapping bodies, I'm not talking about, just delete some of these things whilst we're talking. I'm not talking about random overlaps. I'm looking at when the high and the low of the candle specifically overlaps. And that's what I like to look at for it. I'm just trying to see if I can see one. I mean, you get a little one here and it reacts off. I want to find a cleaner one for you, so when you're learning you can see. It's usually them like when we're in the big trends like in New York. So let's see if we can spot them. So that might take a while. These aren't ones I typically use as much. Trying to find a really clean example. We'll have to go for a bit of a different one, not so clean, but when I find one that's clean in price, I will let you know. Here we go. Perfect example. So here we have a bullish candle and then a bearish candle. The low of this is slightly lower than the high of this, so the market's traded up, jumped up, closed and ran. So this, where you see the low and the high overlapping, is a P cross delivery array. So So when price can't reach up to a price delivery array, that indicates heavy prices. So say we're here and we can't even reach up to the overlapping candle, but we're bearish. This in itself is what you call an order block, which I'll get into in a second, which can be sensitive at the wick. So they can over that as well. Order blocks can be sensitive at the wick. So what an order block is the last up candle before a downwards move. Okay. So this is the last up one before we plummet lower. So when price trades back up, it's sensitive off the wick. Another PD array, if price would have reached up even further, it would have reacted, which is why I was trying to look for a clean example of this zone, which I'm showing you now. It would have reacted off that. So that, you see how the bodies just overlap? But then I'll prove this would work by look what happens as an inversion. So these bodies here overlapping, extend that through time, which is what you can do with a lot of PD arrays, by the way. You can extend them through time. Makes sense? And look what happens when we touch that PD array. We trade above it, and look what happens when we come back down to it. It's magic, yeah? So to the tick, you're getting in on that, and then it runs the opposite way. Yeah? So you're always looking left on your chart. You're not always looking at the recent leg that we're on. You look left on your chart as well to spot these PD arrays when price reacts. Okay? And then you target in the high. So this is like an order block that's been used lower, take on the lows. And then it's also used as an inversion. Use this PD array here to trade higher. The trick is to go back on your own charts. I think I just pick that one up specifically. In hindsight, blah blah blah. No, it happens all the time. Take a look at your charts, take the time to go into it. Going back into the concept of fair value gaps from the last session, building on that. Say you have a fair value gap here before the market opens, and we're going to trade to all-time highs, which we are, and we've delineated the highs here to relatively equal highs, which is another PD array which we've talked about. If price can't even get down to touch it, we're very bullish. Yeah, same here. So you've got a fair value gap. Price can't even reach up to touch it, so we're what? We're very bearish. Here we go. That's the PD array I'm on about. At a high with that handle. This candle high, try and move on out of the way so you can see. The candle high of this is above of the body, sorry. The body high is above the body low of this candle. They're consecutive up candles. So if price would come down to this, I'd expect a strong reaction. But no, it can't even reach that. Okay? Back to the main chart. So yeah, I think that'll do for this video. Just introducing more price delivery arrays, getting to spot how things are algorithmic in price and things like that. So yeah, I hope this one really helps, and we'll leave it there for that video. We'll talk about how we can use the high time frame in the next video and introduce more and more and more until we can go back and we can look through the charts like we've got an X-ray vision. So yeah, I hope that was helpful. Again, trying to not keep these videos too long, working on this existing chart, and then eventually I'll start working back through other charts, which I have kind of flicked back through a couple of times. But yeah, we'll work on daily bias next, and looking at the high time frame. Peace out again. Thank you for watching. Big appreciation if you are watching, and again, you're helping yourself by watching my videos. So yes, thanks a lot and goodbye.